The Federal Reserve just made a move that, in effect, changes the way gold should be understood inside the U.S. financial system, and it's happening so quietly that most people don't even realize it occurred. Not the headlines, not the television coverage, not the social media experts who can only tell you gold to the moon or gold is a bubble without explaining the mechanism that would make either outcome logically true. What you're about to hear is not a hype story, and it's not a chart reading session. It's a sequence of observable actions and incentives inside the Fed and the Treasury market, plus a geopolitical stress layer that helps explain why gold has been behaving the way it has, even when the Fed's public messaging sounds like it should be bearish for gold. And here's the part that most investors miss. This isn't only about the gold price. It's about the plumbing of the dollar system. It's about how the government funds itself, how banks are being paid, how liquidity is being maintained, and what happens when those pieces stop fitting together cleanly. Once you see the chain of cause and effect, you won't look at your portfolio the same way again. Whether you own gold, silver, stocks, bonds, real estate, a retirement account, or you simply earn and save in dollars. Let's frame this clearly. There are three things we need to do in order to make sense of what's happening. First, we need to identify what the Fed actually did, what changed operationally, and why it matters historically. Second, we need to walk through the mechanism, the step-by-step link between Fed balance sheet behavior, Treasury market stress, the credibility of monetary policy, and why gold reacts the way it does. Third, we need to map the road ahead in phases, because the way this evolves is not one straight line. It tends to move in stages, and those stages determine whether you're early, late, or positioned in the wrong place when the narrative finally becomes obvious to everyone. So let's start with the event itself. Late last year, the Federal Reserve began expanding its Treasury bill purchases again under a phrase that sounds deliberately technical, something like reserve management or balance sheet operations. It's the kind of wording that's designed to avoid one specific phrase, money printing. But call it whatever you want. The functional reality is straightforward. When the Fed creates reserves and uses them to buy government debt, it is injecting liquidity. It is expanding the monetary base. And in practical terms, that is a form of monetary easing, even if the Fed does not want the public to emotionally categorize it that way. Why does that matter? Because for years, the official story was the opposite. The Fed told markets it was tightening, fighting inflation, shrinking the balance sheet, normalizing policy. And it did raise rates aggressively. It did talk constantly about discipline and restraint. Then, without a big QE is back press moment, we get a quiet drift in the other direction. Purchases framed as technical necessities, not policy choices. That shift is the signal. And the reason it matters for gold is not that gold likes money printing in some simplistic way. The reason is that once the Fed is forced back into providing liquidity to keep the system functioning smoothly, the market begins to reprice the credibility of the entire anti-inflation posture. Now let's talk about the math, because this is where the story stops being ideological and becomes arithmetic. The U.S. government is constantly rolling over maturing debt. In any given year, trillions of dollars in treasuries mature and must be refinanced at whatever interest rates exist in the market at that time. When rates are near zero, rollovers are cheap. When rates are 4 to 5% or higher, rollovers become expensive fast. And the cost is not hypothetical, it shows up as interest expense, which has moved into territory that would have been unthinkable not long ago. The U.S. is now paying an enormous amount just to service past borrowing, before a single dollar is spent on defense, healthcare, infrastructure, or anything else. At the same time, the Fed itself has been operating under a stress dynamic that most people don't understand. After the post-2008 era, and especially after the pandemic-era interventions, the Fed's balance sheet became massive. The Fed held large quantities of longer-duration assets purchased when yields were low. Then, when the Fed raised rates, it also raised the interest it pays on reserves. That means the Fed began paying banks relatively high interest on reserves while earning relatively low interest on many of the assets it holds. That creates a negative carry problem. In normal finance, if you borrow at 4% and invest at 1 to 2%, you lose money. A private institution doing that at scale would eventually break. The Fed can't go bankrupt in the ordinary sense, but it can run operating losses, and it has. Losses that are handled through accounting mechanisms that effectively push the recognition of those losses into the future. This isn't about shaming the Fed, it's about understanding incentives. When a system reaches a point where high rates are financially painful for the government and also operationally awkward for the central bank, pressure builds toward easing, not because easing is morally right, but because the structure is stressed. So when you see the Fed resume ongoing Treasury purchases under a technical label, that is not an isolated footnote. It's a directional change. And this is where gold comes in. Gold is not reacting to speeches. Gold reacts to credibility and constraints. Gold tends to do its most powerful moves when markets conclude that the monetary authority is not simply choosing a path, but is being boxed into it. When the Fed is no longer perceived as fully in control of the outcomes it promises. That's the difference between we're easing because we want to and we're easing because the alternative is breakage. The first can be managed. The second damages confidence. Now let's add the second major layer, global institutional behavior. If you want to understand gold's strength over the last few years, you have to look beyond retail investors and beyond the daily news cycle. One of the most underappreciated facts of the current market is that central banks have been buying gold at historically elevated levels. That's not a rumor. That's data reported across multiple reputable sources over multiple years. Sovereign institutions have been increasing their gold reserves at a pace that stands out relative to long-term averages. And the question is why? One major inflection point occurred in early 2022 when the United States and its allies froze a large portion of Russia's foreign currency reserves held in Western jurisdictions. Whatever you think of the politics of that decision, the financial consequence was immediate and global. It demonstrated that reserve assets held in the Western financial system can be politically immobilized. If a sovereign nation's dollar and euro reserves can be frozen by policy decision, then the dollar is not purely a neutral reserve instrument. It's also a geopolitical instrument. And that realization does something inside every central bank that is not fully aligned with U.S. policy. It raises one quiet question. If it can happen to them, can it happen to us? Now, there is only one globally recognized reserve asset that sits outside that sanction architecture in a direct way: physical gold held in domestic custody. That doesn't mean the dollar disappears. It doesn't mean the end of America. It means the world begins to rebalance. And that rebalancing is phase one of the gold bull market, the quiet institutional repositioning phase. Phase one is not chaotic. Phase one doesn't look like a crisis on TV. It looks like gold grinding higher while most people shrug and say, "I don't get it." It looks like the most sophisticated buyers in the system steadily accumulating without advertising it. And it's exactly in phase one that retail investors usually underreact, because retail tends to respond to visible crisis, not invisible risk. Now here's the critical transition. Phase two begins when the market starts to connect the dots between institutional gold accumulation and domestic monetary constraints. In other words, phase two begins when it becomes widely understood that the Fed is not pivoting because it wants to be nice. It's pivoting because the system is strained. This matters because a central bank's greatest asset is not its balance sheet. It's belief. It's the belief that it can maintain price stability, maintain orderly markets, and contain stress without devaluing the currency over time. When markets conclude that the Fed must expand liquidity to keep the Treasury market functioning smoothly, especially as refinancing needs stack up, that belief weakens. And as belief weakens, hard assets that sit outside the system become more attractive, not as a trade, but as insurance. Now add the third layer, and this is where things can compress fast: energy shocks. Over half a century of market history, major oil disruptions have repeatedly coincided with powerful moves in gold. Not because oil equals gold, but because oil shocks do two things that are extremely difficult for policymakers. First, they push inflation into the real economy. Energy is embedded in transportation, manufacturing, food production, logistics, and basic services. When energy costs spike, price pressure spreads. Second, they often occur at times when policymakers are constrained, because the same shock that pushes prices up can also slow growth and stress debt markets. That puts central banks in a trap: fight inflation with higher rates and risk breaking fragile parts of the system, or support the system and accept higher inflation. Gold tends to perform best in that exact trap because gold is not simply an inflation hedge. It's a hedge against the loss of policy flexibility and credibility. Now, I'm not going to pretend I can verify every headline-level claim about every incident in global shipping lanes in real time. But the broader reality is well understood. When tension rises around critical energy choke points, especially in the Persian Gulf region, markets begin pricing risk into oil and shipping. That can show up as higher insurance costs for tankers, rerouted shipping, fewer willing carriers, and a risk premium embedded in crude prices. Even without a total shutdown, The perception of fragility can move prices meaningfully. And if disruptions persist, analysts routinely model scenarios where oil prices rise quickly. So when you place these three layers together, you get one unified picture. Layer 1. Institutional buyers, including central banks, have been accumulating gold because the geopolitical neutrality of reserve assets has been questioned. Layer 2. Domestic U.S. debt arithmetic and banking system incentives increase pressure on the Fed toward liquidity support, even if it is described with careful language. Layer 3. Energy risk acts as an accelerant that can embed inflation while simultaneously constraining the Fed's ability to keep policy tight without causing stress elsewhere. These aren't separate stories. They are the same story from different angles. Now let's talk about Phase 3, carefully, without hysteria and without denial. Phase 3 is not tomorrow. Phase 3 is what happens if structural fiscal reform does not occur and if the bond market begins to demand meaningfully higher yields to absorb ongoing issuance at scale. Economists have language for extreme versions of this. A debt spiral dynamic where higher rates raise interest expense, higher interest expense increases borrowing needs, higher borrowing needs increase issuance, and increased issuance pushes yields higher again. When that feedback loop forms, governments historically resolve it in limited ways: austerity, default restructuring, or central bank intervention via large-scale purchases that effectively monetize debt. The United States has unique advantages: the world's reserve currency, deep capital markets, taxation capacity, and global demand for dollars. So don't misunderstand what I'm saying. This is not a claim that the U.S. becomes Argentina overnight. But even a partial move in that direction, where the Fed is increasingly compelled to absorb debt to prevent disorder, changes what gold represents in a portfolio. That's when gold stops being a commodity that moves around and becomes monetary insurance against a system that is being managed through liquidity. Now, there's another piece of this story that is especially interesting because it shows a gap between fundamentals and public participation: gold mining stocks. At high gold prices, many miners can generate extremely large margins relative to their production costs. In theory, that creates leverage. If gold rises, miner profits can rise disproportionately. And yet, despite periods of strong gold performance, the mining equity space often lags until later in the cycle because investors either distrust miners, chase other narratives, or avoid operational risk. That lag can create an unusual setup where the metal is screaming monetary stress, while the equities tied to the metal are not yet crowded, meaning the public phase of the trade may not have fully arrived. This does not mean miners are free money. Mining comes with operational risk, political risk, cost inflation, and company-specific problems that physical gold does not have. But from a market cycle perspective, a disconnect between strong underlying economics and weak public attention is often what early phases look like. So what do you do with this information? The point is not to panic. The point is to stop outsourcing your understanding to headlines. If you own dollar-denominated assets, you need to recognize what signals matter. Quiet balance sheet shifts matter. Refinancing arithmetic matters. Institutional accumulation matters. Energy risk matters. And most importantly, you need to understand the psychological trap that destroys investors in transitions like this: waiting for certainty. Markets do not offer certainty at good prices. By the time the narrative is obvious and safe to say out loud everywhere, the repricing has already happened. That doesn't mean you make reckless moves, it means you build a framework. Here's a simple way to hold the framework. Gold is the direct hedge against monetary credibility risk. Silver tends to be more volatile and can outperform later in precious metals cycles, but it also swings harder and requires more risk tolerance. Mining equities can offer leverage to the metal but add operational risk that requires selectivity and discipline. Energy and certain defensive sectors can benefit from the geopolitical commodity layer, depending on how events evolve. And the biggest mistake is doing nothing simply because the world feels uncertain. Uncertainty is the environment in which risk premiums reprice. That's when frameworks matter most.